Have you ever looked at a stock chart and felt like it was, well, speaking a language you didn't quite understand?
hmm
What if you could decode those lines and colors, reveal the market's hidden story, give yourself a real edge?
Oh, get ready. This deep dive
Mm.
promises to do exactly that. We're going to unpack the foundational wisdom from Technical Analysis of the Financial Markets by John J. Murphy.
Right, as summarized by Time Affairs. And our mission today really is to take what can seem like a pretty dense, maybe intimidating subject, technical analysis,
Yeah, you could feel that one.
and transform it into clear, actionable knowledge. We want to give you a shortcut, a kind of mental map for understanding market movements, make more informed decisions.
Think of it like learning to navigate the market's ups and downs with a lot more confidence.
Exactly, a map. I like that.
It's a really comprehensive guide, honestly. And we're excited to distill its core wisdom into, well, practical insights for you.
All right, let's dive straight in. The philosophical bedrock of technical analysis. At its core, what's the big idea? And how's it different from, say, fundamental analysis?
Okay, so at its heart, technical analysis is laser-focused on just two things:
Mhm.
the price itself and the patterns of market behavior.
Just price and behavior.
Right. Unlike fundamental analysis, which, digs into company earnings, balance sheets, economic forecasts,
Yeah.
technical analysis operates on a core belief. The price tells us everything we need to know.
Everything. That's a bold statement.
It is. It suggests the price is the ultimate reflection of collective market wisdom. All known information, basically.
Huh. That's a massive shift in perspective for a lot of people. It means you don't necessarily need to be an economist reading every report.
Exactly. So this core belief, it leads directly to Murphy's three foundational principles. They're really the bedrock.
Okay, lay them on us. What's the first one?
First, market action discounts everything.
Discounts everything. What does that mean in practice?
It means all the information out there, good news, bad news, rumors, economic data, everything, it's already factored into the current price. It's already baked right in.
So when you look at a chart,
You're seeing the result. The collective judgment of millions of participants is already reflected right there.
Hmm.
Your job isn't to predict the next news story, but to interpret how the market's already processed it.
wow. Okay, so less worrying about the next announcement, more reading the reaction. Got it. What's principle number two?
The second one is that prices move in trends. Markets don't just zigzag randomly. They tend to move in sustained directions up, down, or sideways.
Ah, the classic, the trend is your friend.
That's the one. It's not just catchy. It's a golden rule. It advises you to, well, align your trading with the market's prevailing direction. Don't fight the current, basically.
Ride the wave. Makes sense. And the third principle. I hear this one gets into, like, human psychology.
It absolutely does. The third principle, history repeats itself. This taps right into human behavior. Emotions like fear, greed, excitement, panic, they haven't changed over centuries.
Literally not.
And these emotions drive trading decisions. They create recognizable patterns on charts that, well, they repeat over time. Studying past market behavior gives you a kind of playbook of human nature.
A playbook. I like that.
Hmm.
So if emotions are constant, the patterns they create should give us clues about the future.
That's the core idea. It offers a way to anticipate potential future movements based on past reactions.
Okay, that makes a lot of sense. Now, talking foundations, we absolutely have to mention the grandfather of it all, Dow theory, Charles Dow.
Absolutely. Charles Dow, the guy behind the Dow Jones Industrial Average back in the early 20th century, he noticed markets don't move in straight lines.
Right.
Instead, they unfold in waves. And crucially, these waves follow identifiable patterns.
Right.
That observation really laid the groundwork for, well, pretty much all technical analysis that followed.
So understanding these waves is key. What are the big ones, the primary trends?
Okay. Primary trends are the market's dominant long-term direction. You've got an uptrend, which is your classic bull market, prices steadily moving higher, lots of optimism.
Buyers in control.
Exactly. Then the opposite, a downtrend, your bear market.
Yeah.
Prices consistently falling, pessimism taking hold.
Sellers dominating.
Right. And then there's the sideways trend, sometimes called consolidation. Prices just kind of bounce around in a range. It's like the market's catching its breath, deciding where to go next.
Taking a breather. Okay, those are the big currents. But it's not always a smooth ride, right? There are smaller waves within those.
That's where secondary trends come in. These are shorter-term bumps or dips, you might call them pullbacks, or corrections that happen within the main primary trend,
And why are they important?
because they're vital to watch. How they behave can give you early signals about whether the bigger trend might be shifting or weakening.
Interesting. And Dow also talked about market phases, which sounds like the psychology behind the moves.
Yes. He identified three key phases reflecting investor sentiment. First up is the accumulation phase.
Accumulation. Sounds like gathering something.
That's exactly it. This is typically when the smart money, think institutional investors, starts quietly buying up stocks, usually at low prices when the general public isn't really paying attention.
The calm before the storm.
Precisely. Getting in early.
Okay, what happens after accumulation?
Next comes the public participation phase. As the trend starts to become obvious and the positive news spreads, more and more investors jump on board.
FOMO kicks in.
You got it. Fear of missing out. This is when the market's riding high, momentum builds, everyone wants in.
And then the tricky part, the distribution phase.
Exactly. This is where the smart money, the early buyers from the accumulation phase, starts to sell. They begin distributing their shares to the still optimistic public.
Ah, so they're getting out while the getting's good.
Pretty much. The market might still look strong on the surface, but it's actually starting to top out. It's showing signs of exhaustion.
Wow. Knowing which phase you're potentially in seems incredibly valuable. Could save a lot of heartache.
It really could. And Dow also stressed the importance of confirmations to avoid, false signals.
Confirmations. How did that work?
To really validate a trend, Dow believed you needed confirmation across different market sectors. Specifically, he looked for both the Dow Industrial Average and the Dow Transport Average to be moving in the same direction.
Ah, so like the companies making stuff and the companies moving stuff should agree on the trend.
Basically, yeah. It acted as a filter to help eliminate false signals and build confidence that the trend was real.
So let's bring this home for the listener. How does Dow theory, something from over a century ago, give us a relevant roadmap for today's markets?
It provides a fundamental framework. It helps you understand the market's underlying rhythm, its heartbeat, if you will. By recognizing these trends and phases, you can seriously improve your timing.
Better timing.
Identify major turning points, and crucially, avoid getting caught on the wrong side of big market reversals. It's like learning to read the market's heartbeat. It gives you direction.
Reading the market's heartbeat. I love that phrase.
Mm.
Okay, so to read that heartbeat, we need the tools, the visual map tots. Let's talk about the main types.
Right, the visuals. The three basic building blocks are bar charts, line charts, and candlestick charts. Each gives you a slightly different lens to view the market.
Let's start with the old school, bar charts. What do they show us?
Bar charts pack a lot into a simple vertical line. Each bar is a specific time period, could be a day, an hour, whatever you set.
Okay.
And each bar shows you four key prices:
Mm-hmm.
the open, the high, the low, and the close, often called OHLC.
OHLC. Got it.
If the bar's green or maybe filled in, the price closed higher than it opened, it's bullish.
Mm-hmm.
If it's red or hollow, the close was low or bearish. They're great for a quick look at the range and where it closed.
Yeah.
Shows volatility too.
Okay. And line charts look much simpler, just a line connecting dots. What's their strength?
Simplicity is their strength. A line chart just connects the closing price from one period to the next. That's it.
Just the close.
Yep. By doing that, it cuts out all the noise of the highs and lows during the period. It gives you a really clear, uncluttered view of the overall trend direction. Great for beginners or just seeing the big picture.
Makes sense. Cuts the clutter. And then the ones we see everywhere now, candlestick charts. Why are they so popular?
Candlesticks are probably the most widely used today because they're so visually rich and pretty intuitive once you get the hang of them.
How do they work?
Like bar charts, they show the open, high, low, and close, but they have that thicker part, the body, which shows the range between the open and close.
It's a colored part.
Right. Green body means the close was higher than the open.
Yeah.
Bullish. Red body means the close was lower. Bearish. Then you have the wicks or shadows, thin lines sticking out, showing the period's absolute high and low. What makes them great is they give you a real sense of the market's felt emotion during that time. Was it a strong push-up, a struggle? You can almost see the psychology.
Seeing the psychology. Interesting. So beyond individual bars or candles, how do we read the overall story the chart is telling?
Price isn't just a number, right? It's telling a story about supply and demand, moment by moment. In an uptrend, for example, you'll consistently see the price making higher highs and higher lows.
Higher peaks and higher valleys.
Exactly. That tells you buyers are generally in control. It's usually a signal to look for opportunities to buy or hold.
And a downtrend.
That's characterized by lower highs and lower lows, lower peaks, lower valleys. That signals sellers are dominating and it might be time to consider selling or shorting.
Okay. And when it's just chopping sideways.
That's sideways movement or consolidation. The price is basically stuck in a range. It shows indecision. Neither buyers nor sellers have clear control. You're often just waiting for a breakout one way or the other.
So recognizing those three basic modes, up, down, or sideways, is step one.
Absolutely fundamental. Uptrend. Buyers pushing higher. Downtrend. Sellers pushing lower. Sideways. Market taking a breather, consolidating before its next move.
Crucial distinction. Now, let's talk about those invisible lines everyone talks about. Support and resistance. What are they?
Think of them as horizontal price zones where the market tends to react. Support is like the floor of the market. It's a price level where buying interest typically comes in strong enough to stop prices from falling further, or at least pause them.
Buyers step in.
Right. And resistance is the opposite, like the ceiling of the market. It's a price level where selling pressure tends to emerge, stopping prices from rising higher.
Sellers take control.
Exactly. Price often struggles to break through these levels.
And I've heard they're not set in stone, like a floor can become a ceiling.
That's a critical point.
Mm.
What was once a support level can turn into resistance, and vice versa, once it's decisively broken. This is called polarity.
Polarity, okay.
So if price breaks below a support level, that same level might act as resistance on the way back up. It's a very common and important concept.
Got it. So beyond these horizontal levels, we use trend lines and channels to track momentum visually. How do trend lines work?
Trend lines are super simple, yet really powerful. They're just diagonal lines you draw on the chart to connect key price points. They give you a visual representation of the market's momentum.
How do you draw them?
In an uptrend, you draw the line connecting the rising lows, the valleys. This line then acts as a kind of dynamic support. In a downtrend, you connect the falling highs, the peaks, and that line acts as dynamic resistance.
Dynamic support and resistance. Okay. And channels, just add another line.
Yep, channels take trend lines a step further. You draw a parallel line to your main trend line. So in an uptrend, you draw a parallel line above the price action, touching the highs. That's an ascending channel.
And a descending one for downtrends.
Exactly. You draw a parallel line below the price action in a downtrend, connecting the lows. The beauty of channels is they visualize the potential range of price movement within the trend. They act like moving support and resistance boundaries.
That paints a clearer picture of the trend's path. Okay, we've got our map. We know the basic terrain. Now for the real detective work, decoding market behavior with specific patterns and signals. Let's start with the big ones. Major reversal patterns, the ones that tell us a trend might be ending.
Right. These are key signals. Spotting them suggests the current trend might be running out of steam and a significant change in direction could be coming. Very valuable if you can see them forming.
The head and shoulders pattern often gets called the most reliable. What does it look like?
It's a classic for a good reason. It forms three peaks. You get a left shoulder peak, then a higher peak, the head, and then a third lower peak, the right shoulder.
Left shoulder, head, right shoulder. Got it.
The crucial part is the neckline. That's a line drawn connecting the low points between those three peaks.
Okay, the valleys between the peaks.
Exactly. A decisive break below that neckline, usually after the right shoulder forms, is often a strong signal that the uptrend is reversing into a downtrend.
And there's an upside down version too.
Yep, the inverted head and shoulders. Same pattern, just flipped. Appears after a downtrend and signals a potential reversal upwards.
Makes sense. What about double tops and double bottoms? They sound simpler.
They are, and often just as effective. A double top is bearish. Price hits a peak, pulls back, rallies again to roughly the same peak level, but fails to break higher. It forms sort of an M shape.
An M? Okay.
A break below the low point between those two peaks confirms the potential start of a downtrend.
And the double bottom is the W.
Exactly. A double bottom is bullish. Price hits a low, bounces, comes back down to test that same low area again, and then rallies strongly. A break above the high point between the two lows confirms a potential uptrend, like a W.
M for top, W for bottom, easy to remember. And triple tops bottoms are stronger versions.
Pretty much. They offer stronger confirmation because the market has tested that key level 3 times and failed to break through. More reliable, but rarer.
Okay. Then you have saucers. That sounds slow.
They are. A saucer is a slow and gradual reversal pattern. It takes a long time to form, looks like a shallow curve. It indicates a very slow, methodical shift in trend direction. You can have bearish saucers at market tops and bullish ones at bottoms. Definitely long-term patterns.
And at the other extreme, V-shaped reversals. Those sound fast.
They are. Exactly what they sound like. A sharp, dramatic reversal. Very little warning. A V-shaped bottom is a sharp drop followed by a sharp rally, very bullish. A V-shaped top, or inverted V, is a sharp rise followed by a sharp plunge, very bearish. They're fast and intense and can completely shift market sentiment almost instantly.
Wow, quite the range of reversal signals. But not all patterns mean the trend is over, right? Some just signal a pause. Continuation patterns.
Exactly. These patterns suggest the market is just taking a breath, consolidating its energy before likely resuming the existing trend.
Like triangles, how do they show consolidation?
Triangles form when the price range starts to narrow, squeezing tighter and tighter. It shows indecision, a battle between buyers and sellers.
Different kinds of triangles.
Yep. A symmetrical triangle has lower highs and higher lows, converging towards a point. It signals indecision before a likely breakout. An ascending triangle is generally bullish. You see higher lows pushing up against a flat resistance level, shows building buying pressure.
Buyers getting stronger?
Right. A break above that flat top usually signals the uptrend will continue. A descending triangle is the bearish version, lower highs, pushing down against a flat support level. Shows sellers are gaining control. A break below support often means the downtrend resumes.
Okay, triangles show coiling energy. What about flags and pennants?
These look like, well, flags on a pole. You get a sharp, strong price move, that's the pole. Then a brief consolidation period where the price drifts slightly against the direction of the pole, that's the flag, often rectangular or channel-like.
A counter move.
Yeah, a small pullback. The expectation is that the price will break out of the flag in the same direction as the original pole, continuing the trend. Pennants are very similar, but the consolidation part looks like a small symmetrical triangle instead of a rectangle. Both are typically short-term patterns.
Quick breathers. And wedges. How are they different from triangles?
In wedges, both boundary lines slope in the same direction, but they still converge. A rising wedge has both lines sloping upwards, but price narrows. Interestingly, after an uptrend, a rising wedge often breaks downwards. It signals loss of bullish momentum.
So a rising pattern breaks down. Counterintuitive.
It can be. And a falling wedge, where both lines slope down, often breaks upwards after a downtrend. It suggests selling pressure is easing.
Okay, need to remember those potential reversals. And finally, rectangles.
Rectangles are probably the simplest consolidation. Price just bounces back and forth horizontally between a clear support level and a clear resistance level. It's a classic consolidation period, a sideways channel. When price eventually breaks out of that box, it usually signals the direction of the next leg of the trend.
Like shaking a soda bottle before it pops.
Yeah, something like that, building pressure within the range.
Okay, that's a great tour of chart patterns. But it's not just the shapes, right? We need to look at the fuel behind the moves. Volume and open interest. How do they help?
Absolutely crucial. These tell you about the conviction, the participation behind the price moves. Volume is simply how many shares or contracts were traded in a given period. It's like the heartbeat of the market.
Heartbeat. Okay. High volume means?
High volume generally suggests strong interest and conviction. It validates the price move. If price jumps up on high volume, it's more likely to be a genuine move. Low volume suggests weakness, lack of interest, maybe a move that's easily reversed.
Got it. And open interest. I hear that mainly with futures and options.
That's right. Open interest is the total number of contracts that are still open, that haven't been closed out. It gives you a sense of the overall market participation and commitment.
More contracts open means more people are involved.
Exactly. High and rising open interest suggests new money is coming into the market, supporting the trend. Falling open interest suggests participants are closing positions, losing interest in the trend.
So how do volume and open interest work together? What are the key scenarios?
They paint a much clearer picture together. For confirming a trend, the ideal scenario is high volume and increasing open interest accompanying the price move. For example, price rising, volume rising, open interest rising that strongly confirms buyers are actively entering and holding positions. A healthy trend.
And what about spotting potential reversal signals?
Look for divergences. For instance, if price keeps rising but volume starts to drop off, that's a warning sign, even stronger. Price rising, but open interest is falling. That suggests longs are taking profits, closing out, and new buyers aren't stepping in strongly. The trend might be losing steam.
What about those fake moves or fake outs?
Sometimes you'll see a sharp price spike on high volume, but open interest doesn't increase much or even falls. That can suggest a lot of short-term churning or speculation, maybe stop-loss hunting, but not much long-term commitment entering the market. The move might fizzle out quickly.
High activity, low commitment. And the opposite, lack of participation.
That would be low volume and low open interest. It signals a dull, quiet market. Nobody's really interested. Price movements in this environment tend to be erratic and unreliable. Hard to trust them.
So looking at volume and open interest together really helps gauge the strength and validity of what you're seeing on the price chart itself, goes
Uh-huh.
beyond just the pattern.
Exactly. It adds a crucial layer of confirmation, telling you about the conviction behind the moves.
Okay, fascinating stuff. We've covered philosophy, charts, basic patterns, volume. Now let's get into some advanced tools and context to refine things further. How about long-term charts? Why look at weekly or monthly charts?
It's all about perspective. Using longer-term charts like weekly and monthly helps you spot the macro trends, the really big overarching moves that can last for months or even years.
Seeing the forest, not just the trees.
Precisely. It helps you filter out the noise of daily fluctuations and lets you align your trades with the bigger trend. This can dramatically improve your results, helping you catch those major sustained moves.
So what specifically should we look for on these long-term charts?
Well, obviously, the long-term trend lines become very significant. Also, longer period moving averages, like the 50-week and 200-week moving averages, are key. They act as major dynamic support or resistance levels.
50 and 200 week. Okay.
You also look for major long-term support and resistance zones, and even those classic patterns like head and shoulders or double tops bottoms can play out over many months, signaling huge potential shifts.
Wow. So it really helps you stay on the right side of the market and avoid getting shaken out by short-term volatility. Helps you capture big moves.
That's the goal. Context is everything.
All right. Next up, moving averages. We mentioned them briefly, but let's dive deeper. They're fundamental trend-following tools, right?
Absolutely fundamental.
Mm.
A moving average basically smooths out price data. By calculating an average price over a chosen period, it helps eliminate the noise and makes the underlying trend much clearer to see.
And the main types are simple, SMA, and exponential, EMA.
Correct. The simple moving average SMA is the most basic, just the straight average of prices over, say, the last 50 days. Easy to understand, but it can lag a bit, be slow to react to sharp turns.
Okay.
The exponential moving average EMA tries to fix that lag by giving more weight to the most recent prices. This makes it more sensitive and quicker to react to price changes, often preferred in faster moving markets.
EMA is more responsive. Got it. And people use moving average crossovers as signals.
Yes, that's one of the most popular ways to use them. A bullish crossover, often called a golden cross in longer time frames, happens when a shorter-term moving average, like the 50-day, crosses above a longer-term one, like the 200-day, often seen as a buy signal or confirmation of an uptrend.
And the opposite is bearish.
Right. A bearish crossover, sometimes called a death cross, is when the shorter-term average crosses below the longer-term one, seen as a sell signal or confirmation of a downtrend.
Golden cross, death cross, very evocative names, and moving average envelopes.
That's a bit more advanced. You take a moving average and then plot bands a certain percentage above and below it. If the price hits the upper band, it might suggest overbought conditions. Hitting the lower band might suggest oversold conditions. Creates a kind of trading channel around the average.
So moving averages help identify trends, act as dynamic support resistance, and generate crossover signals. Pretty versatile.
Very versatile and powerful when combined correctly with other tools. They really help cut through the day-to-day chop.
Okay, let's shift gears to oscillators and contrary opinion. Oscillators help measure momentum, right? What are they exactly?
Oscillators are indicators that, well, oscillate. They move back and forth within a defined range, usually between 0 and 100, or around a zero line. Their main job is to help identify overbought or oversold conditions.
Like the market getting too stretched one way or the other.
Exactly. And they also give insights into the momentum, the speed and strength of price movements.
The relative strength index, RSI, is probably the most famous one.
Definitely one of the most popular. RSI measures the speed and change of price movements. A common interpretation is that a reading above 70 is considered overbought, suggesting price might be due for a pullback. A reading below 30 is considered oversold, suggesting a potential bounce.
70 and 30 are the key levels.
Typically, yes. But arguably, the most powerful signal from RSI and many oscillators is divergence.
Ah, divergence again. Explain that in the context of RSI.
Okay, divergence happens when the price makes a new high, but the RSI fails to make a new high or even makes a lower high. That's bearish divergence. It signals that the momentum behind the price rise is weakening, even though price is still going up. Often precedes a reversal down.
So price goes up, but momentum indicator goes down or sideways.
Right. And bullish divergence is the opposite. Price makes a new low, but the RSI makes a higher low. It shows selling momentum is fading, potentially signaling a reversal upwards is coming. It's a really valuable heads up.
A heads up that the trend might be losing steam. Very useful. What about the stochastic oscillator?
Stochastics compare a security's closing price to its price range over a given time period. Like RSI, it has overbought, typically above 80, and oversold, typically below 20 levels. Traders also watch for crossovers of its two lines, per C and per CTD, for buy-sell signals.
80 and 20 for stochastics. Got it. And
Got it.
MACD, that sounds like an acronym soup.
Huh. Moving average convergence divergence. MACD is a really popular trend-following momentum indicator. It basically shows the relationship between two exponential moving averages, usually 12-period and 26-period.
How does it work?
You get the MACD line itself and then a signal line, which is usually a 9-period EMA of the MACD line. Crossovers between the MACD line and the signal line generate buy and sell signals. And, importantly, MACD is also excellent for spotting divergence, just like RSI.
So this concept of divergence is really a central theme for oscillators.
Absolutely critical. Price doing one thing, momentum doing another. It's a major warning sign that the current trend may be losing momentum and could be about to reverse. Bullish divergence. Lower low in price, higher low in oscillator. Yeah. Bearish divergence. Higher high in price, lower high in oscillator. Understanding this gives you a heads up before the trend turns.
Invaluable heads up. Now, beyond momentum, there are contrary opinion indicators. These sound like they measure crowd psychology.
That's exactly what they do. They try to gauge overall market sentiment. Are investors too bullish or too bearish? The idea is that the crowd is often wrong at major turning points.
Be fearful when others are greedy, and greedy when others are fearful.
That's the essence of it. The put-call ratio is a classic example. It compares the trading volume of put options, bets on prices falling, to call options, bets on prices rising.
How do you read it?
A very high ratio suggests a lot of fear and bearishness. Paradoxically, extreme fear can be a bullish signal. Maybe the selling is exhausted. A very low ratio suggests excessive optimism or complacency. That might be a bearish signal. Maybe the buying is overdone.
Interesting. And the VIX, the fear index.
The VIX measures expected market volatility based on options prices.
Yeah.
A high VIX signals high uncertainty and fear. Historically, spikes in the VIX often coincide with market bottoms, maximum fear. A very low VIX suggests complacency and low fear, which sometimes precedes market tops.
So using oscillators for momentum and these sentiment indicators for crowd psychology gives a much richer picture.
It really does. It provides a much clearer understanding of market conditions, both the internal strength and the external mood.
Okay, let's look at a less common but interesting tool, point and figure charting. You called it often underappreciated. How does it offer a cleaner view?
P&F charts are unique because they're price-only charts. They completely ignore time. Unlike everything else we've discussed, the horizontal axis isn't time. It just represents price reversals.
Ignores time. How does that work?
You define two things.
Yeah.
A box size, the minimum price move required to make a mark, and a reversal amount. How much price has to move in the opposite direction to start a new column?
Box size and reversal amount. Okay.
If the price moves up by the box size, you plot an X in the current column. If it keeps going up, you stack X's. If price reverses down by the reversal amount, say 3 boxes, you move one column to the right and start plotting O's downwards. You only move horizontally when the trend reverses significantly.
X is for up moves, O is for down moves. New column only on reversal.
Exactly. The big benefit is huge noise reduction. Small, insignificant price wiggles just don't show up. This makes P&F charts incredibly trend-focused and excellent for identifying clear support and resistance levels in classic chart patterns. Offers real simplicity.
Fascinating way to filter out the noise. Okay, let's swing back to Japanese candlesticks, but go deeper into their hidden language via specific patterns.
Right, we touched on the basics, but the real power comes from recognizing specific candlestick patterns, often involving 1, 2, or 3 candles. They really tell you about the market's emotions.
Give us some key aha moments. What's a doji?
A doji is a candle where the open and close prices are almost exactly the same, so the body is just a thin line, or non-existent. It represents indecision, a stalemate between buyers and sellers, often signals a potential reversal, especially after a strong trend.
Indecision. Okay. What about engulfing patterns?
These are powerful 2-candle reversal patterns. A bullish engulfing occurs in a downtrend when a large green candle completely engulfs the body of the previous small red candle. Shows buyers have suddenly overwhelmed sellers.
Buyers take charge.
Yep. And the bearish engulfing is the opposite. In an uptrend, a large red candle engulfs the previous small green one. Sellers seize control.
Very visual signals and things like the hammer and hanging man. They look alike but mean different things.
Exactly. Context is crucial. A hammer is bullish. It appears after a downtrend, has a small body near the top, and a long lower wick. Shows buyers rejected lower prices and pushed it back up.
Buyers fought back.
Right. An inverted hammer is similar. Wick at the top, also potentially bullish after a downtrend. But the hanging man looks just like a hammer, but appears after an uptrend. It's potentially bearish, signaling selling pressure came in during the session. Same shape, different implication based on location.
Location.
Absolutely. Same with a shooting star, looks like an inverted hammer, but occurs after an uptrend. It's bearish, showing buyers tried to push higher but failed.
Got it. What about multi-candle patterns like morning star, evening star?
Those are powerful three-candle reversal patterns. Morning star is bullish, typically appearing at a bottom, a large down candle, then a small body candle like a doji or spinning top, then a large up candle signals a strong reversal up. The evening star is its bearish counterpart at a top.
Three-candle confirmation and dark cloud cover piercing pattern.
Those are two-candle reversal patterns. Dark cloud cover is bearish. After an uptrend, a down candle opens above the previous high, but closes more than halfway down the body of the previous green candle. Shows strong selling pressure. The piercing pattern is the bullish equivalent at a bottom.
Lots of specific patterns to learn, but the key is context and confirmation.
Absolutely. Never trade a candlestick pattern in isolation. Always look for confirmation from other indicators. Volume, trend lines, support resistance, moving averages. Context is everything.
Makes sense. Okay, let's tackle a big one. Elliott wave theory. Sounds complex, intricate, yet fascinating.
That sums it up well. Elliott wave theory is built on the idea that market prices move in predictable, repetitive cycles driven by mass psychology. These cycles consist of impulse waves that move with the main trend and corrective waves that move against it.
Impulse and corrective. How many of each?
The basic pattern is 5 impulse waves labeled 1, 2, 3, 4, 5, moving in the direction of the larger trend. Wave 3 is often the strongest and longest.
5 waves forward.
Followed by 3 corrective waves, labeled A, B, C, moving against the preceding impulse. These are often much slower and less decisive. So it's a 5-3 pattern that forms one complete cycle.
5 waves forward, 3 waves back. And Fibonacci numbers are key here.
Heavily involved. Fibonacci ratios are used extensively to project the potential length of waves and the depth of corrections. For example, wave 2 often retraces 50% or 61.8%, a key Fibonacci ratio of wave 1. Wave 4 often retraces 38.2% of wave 3. It provides a mathematical framework for predicting price movement within the wave structure.
Wow, that adds a mathematical layer to crowd psychology. And these patterns repeat on different scales. Cycle analysis.
Yes, Elliott proposed that these wave patterns are fractal. The same 5-3 structure appears on long-term charts, primary cycles, intermediate charts, and even intraday charts, minor cycles. Understanding where you are in the larger cycle can theoretically help anticipate the next move. It's complex and subjective, though. Best used with other tools.
Fractal patterns in market psychology. Deep stuff. Lastly, in this section, time cycles, using time as a predictor.
Yeah, this explores the idea that markets exhibit repeating patterns occurring at regular intervals. Not just price patterns, but time-based ones, influenced by things like economics, seasons, even psychology. The idea that the past can tell us about the future regarding timing.
Like seasonal cycles. We see those everywhere.
Exactly. Think agriculture, planting harvest, retail spending around holidays, energy prices in winter, summer. Stock markets historically have shown seasonal tendencies too, like being stronger in the second half of the year, though that's never guaranteed.
And those really long waves, Kondratiev waves.
Pay waves. Named after Nikolai Kondratiev, these are long-term cycles in economic history, roughly 50 years long. They're thought to be driven by major technological or societal shifts. Each wave has phases like expansion, crisis, recession, recovery. Very macro perspective.
Super macro. Are there shorter time patterns too?
Oh yeah. People study daily patterns. Monday effect, Friday effect, weekly, monthly tendencies, even decennial patterns like the presidential cycle in the U.S. market, where the third year of a term has historically been strong.
So how do you use time cycles effectively?
You look at historical data for recurring patterns. But, like everything else, combine time cycles with other technical indicators for stronger signals. And stay flexible cycles can shift, lengthen, shorten, or be disrupted by major events.
Another layer to consider. Okay, let's bring this into the modern world. The human element in modern trading. First, computers and trading systems. How have they changed the game? The automated edge.
Hugely. Automated trading systems are basically computer programs designed to execute trades on your behalf based on preset rules. They analyze data and act way faster than a human ever could.
And you need to test them first. Back testing.
Absolutely critical. Backtesting means running your system's rules on historical market data to see how it would have performed in the past. It helps you evaluate profitability, find flaws, and hopefully refine and improve your system before live trading with real money.
Makes sense. Test drive it first. And
Yes.
algorithmic trading, that sounds even faster.
It is. Algo trading uses advanced mathematical models to execute trades at high speeds and volumes, often in milliseconds or microseconds. High-frequency trading, HFT, is a subset of this. The goal is often to exploit tiny price differences, optimize execution, reduce costs. It's like having a super-fast, incredibly intelligent trading partner working 24/7.
The benefits seem obvious. Speed, efficiency, maybe taking emotion out of it.
Yes, speed, efficiency, eliminating emotion, because the machine just follows rules. The ability to backtest and optimize, and trading around the clock in some markets. Those are big advantages.
But what are the downsides? The challenges?
Well, technical failures are a big one. A glitch in the code or connection can lead to huge, rapid losses. There's also over-optimization, tuning a system so perfectly to pass data that it fails miserably when market conditions change slightly in the future.
Curve fitting the past.
Exactly. And ultimately, no algorithm is foolproof. Markets are complex, sometimes chaotic. Algorithms can't predict everything, and sometimes they can even worsen volatility during crises if many algos react the same way at the same time.
Technology is powerful, but not magic. Which brings us to maybe the most important part for individual traders: money management and trading tactics, protecting your capital.
Paramount. You can have the best analysis in the world, but if you don't manage your money correctly, you will eventually blow up your account. This is one of the most crucial aspects of trading.
So what are the key tools here? Risk-reward ratios.
Yes. Before taking any trade, you need to assess the potential risk versus the potential reward. Is the potential profit significantly bigger than the amount you're risking if you're wrong? You should aim for a minimum risk-reward ratio of 1 to 2 or higher.
Risk $1 to potentially make $2 or more.
That's the idea. It means your winners can more than cover your losers, even if you're not right every time, which you won't be.
Okay.
Yeah.
And the safety net. Stop-loss placement.
Your absolute best friend for managing risk. A stop-loss is a preset order to exit a trade automatically if the price moves against you to a certain level. It cuts your losses without emotion.
Takes the decision out of your hands when things go wrong.
Crucially, yes. It prevents that hope that maybe it'll come back, feeling that can lead to huge losses. The key is placing it logically, often just beyond a significant support or resistance level that, if broken, would invalidate your reason for being in the trade.
Strategic placement, not just random.
Yeah.
And position sizing. How much to bet on each trade.
This is huge. Position sizing determines how much of your capital you allocate to a single trade. A common rule is risking only a small percentage, say 1% or 2%, of your total trading capital on any single idea.
Only risk 1% per trade.
For example, it helps control your overall exposure to risk. It means you can take a string of losses, which will happen in stride, and keep your capital intact to trade another day. It prevents 1 or 2 bad trades from wiping you out.
Survival is key. Okay, we've covered tech, patterns, money management. But then there's the mind game. Trading psychology. Just as important, you say.
Absolutely. Arguably more important in the long run. You can teach some of the technicals, the risk rules, but mastering your own mind, that's the final frontier. Mastering your mind.
And the biggest demons are fear and greed.
The classic culprits. They are the biggest challenges and can absolutely ruin your account balance. Fear makes you exit winners too soon or hesitate and miss good entries. Greed makes you hold losers too long, add to losing positions, or take oversized risks hoping for a home run.
How do you fight them?
Discipline. Sticking religiously to your trading plan, your entry rules, exit rules, stop losses, position sizing, trusting the system you developed, avoiding impulsive decisions based on excitement or panic. Don't chase the market. Don't overtrade out of boredom.
Easier said than done, I imagine. And you have to learn to accept losses.
100%. Losses are not just possible, they are inevitable. They are a cost of doing business and trading. The key is how you react. Don't get emotional. Analyze them. Ask, what went wrong? Did I follow my plan? What can I learn?
Learn from mistakes.
Yes. That mindset shift from fear to learning is key to long-term success. Treat losses as tuition fees paid to the market.
Tuition fees. I like that. So the big takeaway for you, the listener, success requires a solid game plan, technical analysis plus money management, and a deep understanding of your own psychology. Controlling risk, managing losses calmly, staying disciplined under pressure. That's the secret sauce.
It really is. This deep dive hopefully has been a gold mine of insights. Reading charts, spotting trends, making more informed decisions. It's all connected.
You should now have a much deeper understanding of how the market behaves, armed with concepts from the basic philosophy right through to complex patterns in psychology.
Yeah, all the toolkit.
So as you go out and look at markets, maybe consider this. How much of technical analysis isn't just lines on a screen, but actually a reflection of timeless human emotions, fear, greed, hope, panic playing out collectively day after day?
It's a fascinating question. We really encourage you to start observing these patterns, these principles, in any charts you come across.
Right.
There's stocks, crypto, commodities. The market story is there, waiting to be read. Start looking.